Welcome. Today we are looking at bank reconciliation. We want to find out why is bank reconciliation important in a company, in an organization, in your business. This is what we're going to look at. Now, in simple terms, you need to understand what bank reconciliation is all about. Bank reconciliation is the process of summarizing the bank transactions and the company transactions so that the balances equalize. Okay, so meaning at the end of the month, the balance in your cash book and the balance of the bank statement should always be equal. So here there are two main documents which are involved. Document number one is the cash book itself, and document number two is the bank statement. We are very aware that the cash book is prepared by the company. The company accountants are the ones that prepare the cash book, while the bank statement is prepared by the bank. Okay. The other thing that you must note is that the cash book and the bank statements, like I said earlier on, must always be equal. Those balances at the end of the month, they should always be equal. The differences in balances of the two documents must be analyzed properly and reconciled. So, what I want us to do today, because we are going to do bank reconciliation in 3 parts. So this is part 1, where we are going to look at the reasons why there are always differences between the cash book and the bank statement. Then in part 2, we are going to look at adjusting the cash book as you prepare for bank reconciliation. And then part 3, we shall look at the bank reconciliation statement itself. So now, the first thing that we are going to do today is to look at the reasons that causes the two documents, the cash book and the bank statement, to have the differences. So reason number 1 are the errors. There are times as we are doing the posting, maybe you are posting to your ledger, you are posting to your cash book, you make a mistake. Okay? So instead of writing a credit balance, you write a debit balance, or you debit the figure. That will cause the difference between the cash book and the bank statement. Sometimes this error can be made at the bank. Okay, the people in charge of our books at the bank will make a mistake. Okay, maybe enter a credit balance as a debit balance. That will cause a difference. So that is an error. Difference number 2 is credit transfer. A credit transfer, this is a transfer that does not pass through our cash book, but it goes straight to our bank. For example, if a data for the company, the debt is due for the payment. Instead of writing a check and bringing it to the company so that it is entered in the cash book, this data will decide to transfer the funds direct to the company account. It means this transfer is not captured in the cash book. It will only be seen as a credit in the bank statement. So that will cause the difference. The third difference will be account maintenance fees. Account maintenance fees, these are small charges that the bank will charge our accounts, okay? So the bank will be able to deduct monies. Why? For maintaining the company account, your account with that bank. And yet, you, as the people responsible for the cash book, will not notice that a certain amount has been deducted from your bank account. Difference number 4 are the service charges or bank charges. Under the bank charges, when the bank is deducting from your account, it will never inform you. You only come to see this charge when you get a bank statement. So the bank will just deduct from your account without notifying you. So at the end of the month, when you would like to do your reconciliation, it's when you see that a certain amount was deducted by the bank in the name of bank charges. The other difference is interest credited. Interest credited. Interest credited simply means that when you maintain a certain amount of money in your account at the bank for a certain period, the bank will be able to give you interest. Okay? And the bank will never communicate to you to say it has given you a certain amount for maintaining a balance, for maintaining the money in the bank for a certain period. It will just credit your bank without you knowing. The other reason for the difference is the standing orders. Standing orders. The standing orders, these are instructions that companies give to the bank. At a certain point or at a certain time, then the bank will be able to make a payment on behalf of the customers, on behalf of the companies, on behalf of all the customers that have given such an instruction. So, a transaction will be made without you knowing, because you already gave the permission to your bank to do such as a transaction or to pay on your behalf. The other reason for the difference is uncredited checks. Uncredited checks. These are the checks that the company has received, entered in the cash book, and deposited in the bank account. But the bank account has not yet, or the bank has not yet cleared them. Okay, the monies have not yet reached your account. So such checks are called uncredited checks. Reason number 8 is unpresented checks. Unpresented checks, these are the checks, okay, are the checks that a company will receive, but instead of taking to the bank and deposit, the company will keep these checks in the drawers, okay? They are deposited for a later, or they are deposited in the bank at a later date. While the company that paid paid these checks or prepared these checks will have entered in the cash book and expecting that the bank will automatically transfer the money to the addressee or the company that is supposed to receive this money. And yet this company that received these checks has just kept the checks in the drawers at the company, okay, until at the month end. Then the following month, you find that this company is winning. The company will now take these checks to the bank. This will create the difference because the company that prepared these checks paid at the right time, expecting that the recipient company will also deposit, but these checks were kept for a later date. Reason number 9, dishonored checks. Dishonored checks. Okay. Dishonored checks also will cause a difference. Why? Because here's a check that has been paid to a company, entered in the cash book, and deposited. Okay? At the month end, maybe this will not show. But the following month, this check is unpaid. Okay? It is not paid. While it was entered in the cash book. So in the bank statement, this check will show that it has not been paid. While in the cash book, it was entered as a debit, money received. But in the cash book, it has been brought back. It's not honored. Therefore, a dishonored check will cause a difference because the company will regard it to say it has received money, but the bank will not pay it. Reason number 10, which is the last one for today, wrongful deposits or credits. Okay, so reason number 10, these are wrongful deposits or credits. Okay, here again, due to fatigue, you find that a person will be, or the accountant will make a mistake. A figure which is supposed to be credited will be debited, or the figure that is supposed to be debited will be credited. So this will cause a difference between the cash book and the bank statement. All these are supposed to be reconciled at the month end, and then the balances should always equalize. Okay, so this has been the first part of bank reconciliation. See you next time.